I'm John Hanna for CityTV.net here in New York City, and we have Dirk Van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Good afternoon, Dirk.
Good afternoon, John.
How are you today, sir?
Oh, not too bad.
The wanted to ask you about this numbers that's coming up, that came up already. The personal income and spending. We had this reflection on some of the other reports with regards to the job market. So, what does it say right now with the personal spending?
Well, yeah, we got those numbers on Friday, and it was kind of a mixed bag. The personal income side continues to just plod along. It was up 0.2% in February, the same rate as in January. It was a little bit below expectations. In the 0.3% growth was expected. So just sort of slow and steady there. The big news on the report was on the spending side, the personal consumption expenditures, which in terms of the GDP numbers is far more important, at least in the short term. All right, long term, you're going to need the income to support the spending, but in terms of what you're looking for in first quarter GDP, it's the spending side that's really going to count, and that was up 0.8%. That was up from 0.4% in January, and January was revised up from 0.2%, and also December was revised up to 0.2 from 0. Now those are seasonally adjusted numbers, so people shouldn't be saying, what's spending in December when everybody's shopping for Christmas was only up a little bit, and in February when there's nothing but the President's Day sale is on mattresses. It was real strong. So I mean, keep that seasonal adjustment in mind. What I did find interesting in the spending numbers is that we're getting back to a much more balanced spending pattern. If you look in the fourth quarter, overall consumer spending is 71% of the overall economy, but in terms of the contributions to the growth of the economy in the fourth quarter, it was very unbalanced. It was virtually all spending on durable goods, specifically autos, which is a really just a sliver of the overall consumer spending. Generally, put it this way: services are about 2/3 of the overall spending, and goods is 1/3. And within the goods, 2/3 of that is on non-durable goods, and 1/3 on durable goods. But the non-durable goods spending and the services spending contributed virtually nothing to the growth in the economy in the fourth quarter, where spending on durable goods accounted for 1.16% of the overall growth of 3%. So better than 1/3 of the growth came from this little sliver of the economy that's about 8% of the overall economy, a little bit less, or excuse me, 8% of the overall economy, and about 11% of the consumer. So I think that it's a little bit more stable, and in January, durable goods are still doing pretty well. The total spending increased 86 billion at an annual rate for the month, and about 19 billion of that was in durable goods. 23% $4 billion in non-durable goods, and services were, call it $43 billion. So, about half in services, and non-durable goods still doing better than non-durable goods, but not anywhere near the disjointed picture that we had in the fourth quarter. On the income side, while the absolute number was nothing to write home about, increasing at a total of $28.2 billion, the quality of it looked pretty good. Private wages and salaries accounted for $17.8 billion of that, with solid contributions from non-farm proprietors income of $2.4 billion. Non-farm proprietors income, it's a very good proxy for small business income. Rental income was up $3.5 billion. That's actually been quite strong for several months in a row. And dividend income continues to rise, up $1.9 billion. Relatively little came out of transfer payments. In other words, Social Security and Medicare, Medicaid, and unemployment. That just accounted for $3 billion of the rise in total personal income, with sort of unemployment insurance income continuing to fall. That fell by $3.4 billion after a $4.8 billion decline in January. In January, we had a huge increase in the Social Security of $20.3 billion, which was an awful big chunk of the total increase in January, because there's an annual step up with inflation for Social Security payments, and that all hit in January. But we still had a $2.9 billion increase in Social Security payments in February, and that's mostly a function of more and more baby boomers retiring. So I mean, overall, I wasn't that impressed with the personal income numbers in terms of the level, but the quality looked pretty solid. You want to see it mostly coming from wages and salaries, particularly private wages and salaries. Now, if you've got a big increase in spending and a little tiny increase in income, implicitly that means that the savings rate is falling, and it fell to 3.7% from 4.3%. It's a very big decline, and over the short term, a declining savings rate will boost economic growth, but you can't really sustain an economy without some savings. So somehow we have to figure out how to get from a very low savings rate to a high savings rate without the savings rate going up and increasing, and slowing down the economy, which is, I'm not sure, mathematically possible to do. No, ideally what we would want to see is income growth very robust and a little bit faster than the spending growth to rebuild it, rather than just a situation where spending is falling faster than income. That's a recipe for a very weak economy, and kind of what we saw when the savings rate really popped in the middle of the recession, was just spending fast and falling faster than income. That's not at all how we want to see the savings rate increase. So it's a little bit worrisome for the long term, because we really do need a savings rate, eventually to get up to around 7.5%, 8%, which is much closer to its long-term average. But the process of getting there is going to be a drag on the economy, and we're sort of moving in the wrong direction, falling to 3.7% from that long-term perspective. But when you add it all up, I think everybody's assessment of what the first quarter growth rate is going to be in terms of GDP had to have been ratcheted up by the personal income and spending report. In terms of what it means for the employment report on Friday, a little hard to say, but increased spending, will generally, particularly when you see services picking up, that probably means that more people are out, at restaurants, and therefore there can be more cooks and busboys and waiters hired. So it doesn't flow in directly, but indirectly, I think it sort of indicates that the job growth that we've been seeing in recent months is probably continued again in March.
Alrighty. That's Dirk Van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. And I'm John Hanna for CityTV.net in New York City.